Welcome to The Explainer. Today, we're going to pull back the curtain on one of the biggest ideas in finance, how to figure out what anything, from a simple IOU to a hot tech stock, is really worth.
All right, let's kick things off with a puzzle we've all seen. You look at the news and it's just this wild, seemingly chaotic dance of market prices. Stocks are up, then they're down. What is actually driving all of that movement?
Well, the secret all comes down to one really important difference. The price you see flashing on a screen, that's just what someone is willing to pay for something at this exact second. But value? That's something much, much deeper. It's the asset's true fundamental worth, and figuring that out is the name of the game.
So how do we find that true value? Well, we need this really cool tool. You can think of it like a financial time machine. It's called present value. And the idea behind it is actually pretty simple. $1 you're promised next year isn't worth as much as $1 in your pocket right now. So to value something, we have to pull all the money it's going to make in the future back into today's terms.
Okay, so to really see this in action, let's start with the most straightforward financial asset you can find, a bond. It's the perfect place to begin because a bond is all about promises. So what is a bond? Honestly, at its heart, it's just a fancy IOU. You, the investor, are lending money to a company or a government, and in return, they give you a piece of paper, a contract, that promises two things. They're going to pay you fixed interest payments on a regular schedule, and then at the very end, you get your original money back. Simple as that. And this is exactly why bonds are the perfect starting point for us. The cash you're going to get, it's super predictable. I mean, it's literally written down in a contract. You know exactly what you're getting and when you're getting it. It's a clear, promised stream of cash.
Okay, but that brings up a really interesting question, doesn't it? If a bond is just a set of fixed, concrete promises that don't change, why on earth does its price bounce around in the market? What could possibly be changing? It turns out the answer has nothing to do with the bond itself, but everything to do with the world around it. Just imagine you own a bond that pays you a nice, steady 3% interest. But then, suddenly, overall interest rates in the market go up, and brand new bonds are being sold that pay 5%. Well, your 3% bond doesn't look so great anymore, does it? To sell it, you'd have to drop the price. It's a seesaw. When interest rates go up, existing bond prices go down. And of course, the exact opposite is true too.
Okay, so that's bonds. Now let's crank up the complexity a bit and jump into the world of stocks. Because if bonds are all about promises, stocks, well, they're about something way more exciting and a lot less certain, expectations. And boom, right there. That's the fundamental difference. A bondholder is basically a lender. You are legally promised your money. But a stockholder, you're an owner. You're not promised anything. You've got a claim on the company's future profits, sure, but those profits are just an expectation, not a cold, hard guarantee. So you might be wondering, how do we value a stock then? Well, it's the same core idea as a bond. We look at its future cash flows. But here's the twist. For a stock, those cash flows aren't fixed interest payments. They're the dividends the company is expected to pay out to its owners for, its entire life, all pulled back into today's value. But see, here's the game changer. A bond's payments are set in stone, but a company's profits and the dividends it pays from those profits, they can grow. This one little variable, the potential for growth, is what makes valuing stocks so much more dynamic. It's the magic ingredient. And this idea of growth, it completely changes the entire game. It injects this huge element of dreaming about the future right into the math. To really see just how powerful this is, analysts have a neat little tool called the constant growth model. It helps us see the effect of growth by making a big, simple assumption that a company's dividends are going to grow at a steady, constant pace, forever. Let's put some numbers to this. Imagine we have this solid, stable company that pays a dividend. Now, if we assume this company will never grow, its dividends are just going to be the same forever, we can calculate its present value. And maybe it comes out to something like $19,231 a share. Okay, now watch this. This is where it gets kind of crazy. We take that exact same company with the exact same dividend today, but we change just one number. Now we assume its dividends will grow by a steady 8% every single year. All of a sudden, the calculated value of that same stock skyrockets to 54,000 won. That's nearly 3 times higher.
I mean, think about what that means. This is a huge takeaway. It shows that for so many companies, the price you see isn't about what they're earning today. It's a bet on what that company could become 5, 10, even 20 years from now. The real value is locked up in that growth story.
All right, so we've traveled from the world of promises with bonds to the wild world of expectations with stocks. Let's pull this all together and figure out what it all means. So here's the valuation toolkit we've built. The big idea, the one thing to remember for any asset is that its true value comes from its future cash flow. Pull back to the present. For bonds, that cash flow is a promise, so they're sensitive to interest rates. For stocks, that cash flow is an expectation, so they are incredibly sensitive to what we think about their future growth. The entire art of investing really is about trying to figure out that true intrinsic value and then comparing it to the price you see on the market. And all of this really leaves us with one last big question for you to think about. When you look at the market, are you just chasing the price, getting caught up in all the daily noise and excitement? Or are you focused on the deeper story, the story of an asset's true fundamental value? Because understanding that difference, well, that changes everything.